Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's CFP certified financial planning professional Tim Stearns, CFP, here with us, ladies and gentlemen. As always, here on the Protect and Grow radio programming, bringing a common sense approach to planning and more information on important financial investment and retirement related topics. We always appreciate the time and perspective, Tim.
Peter, thanks for having me.
And today we've got in store a discussion of 6 stealth taxes that can hit us in retirement. Tim, retirement's long, retirement's expensive, and taxes are a big factor that we are going to need to play in to everybody's retirement. All of us are going to need to consider taxation very carefully, but these 6 that we're going to discuss today may sneak up and bite us if we are not prepared.
Peter, I think, that's why we call them the stealth taxes. A lot of people don't know about these. They're very important. Everyone worries about income tax, and that's definitely something we prepare our clients for. But these other taxes are just as important. And there's about 6 of them. They don't apply to everybody, but some of them definitely apply to us. And I think that, they're stealth, but they come and hit you without you knowing it. And that's why we're talking about them today.
Well, ladies and gentlemen, if you would like to set up a plan for your retirement, to optimize, to protect and grow, your resource for that Protect and Grow plan, of course, is TJ Stearns Inc., and you can reach them at 800-640-2256. That's 800-640-2256. Tim Stearns, CFP, and the rest of the team there can help you to define your goals and make sure that your plan and your dollars are working toward helping you achieve them. 800-640-2256, or you can go online, tjstearns.com, tjstearns.com. Tim, you hit on it. I mean, yes, we're going to talk about these 6 stealth taxes, but income tax is a big, big factor in retirement, especially with the way that this generation has saved for retirement. We're going to have to address that income tax question, and we've got some potential changes coming in the near future on that.
Well, definitely. I mean, right now you have 2023, 2024, and the end of 2025 is when these current income taxes, which are the lowest they've been in over 70 years, sunset. So they'll go back to where they were before, which are higher taxes. And I think a lot of people know that that's brewing out there, but they don't know to what part that means. So I think that that's something to worry about. But to dive right into one of the stealth taxes, this goes along with the Secure Act, which was, basically there's a 10-year inheritance rule, right? Where that if I receive an IRA from someone who's not my spouse, I have to spend that IRA down within 10 years, which, that's all going to be income to me. So any IRAs out there have to be that are inherited, and it's not your spouse, you'll have to pay taxes and all that over 10 years. Now you could do it over 10 years, or you could do it the 10th year that the person has passed, or little by little. But no matter what, it will incur more income tax for people.
Tim, I mean, a lot of people worry about estate taxes and probably aren't at a level where they're going to be impacted by that. But with this generation having saved so much of their retirement assets, as we've been taught and told, and probably has been the proper thing to do in 401ks and IRAs, we have to remember that income tax hasn't hit us yet. And even if we pass away before paying all of it, the IRS will not forget, and they pass that income tax on to the next generation. And so an IRA being inherited by 2 or 3 children, the IRS probably becomes one of the largest single beneficiaries there.
Your partner for life, the IRS, that you never signed up for.
And even beyond, right?
Right. Exactly. Even when you're not here, there'll still be taxes being generated by your portfolio. To your point, that's why we're seeing a lot of people try to spend down, meaning convert IRAs into Roths so that their kids don't run into this 10-year inheritance. But I will say this, even that with a Roth has to be terminated within 10 years. So if I have $100,000 in a Roth that I receive from someone who's not my spouse, I'll still have to spend that down. There's no taxes, which is the good news. But, a lot of people are trying to get stuff in under the wire here to do conversions. We've helped a lot of people doing that. And, with having a CPA on staff, it's pretty easy to show people how to do that.
Tim, this really makes IRAs for our retirement purposes, right? Like that they are intended for and best utilized for our retirement, but actually rather poor generational wealth transfer tools because of this 10-year required payout, IRA or Roth. There may be other options that are more advantageous to leverage generational wealth.
Well, yeah. And if you're talking about life insurance, I love that idea to take your money from your IRA and spend it down into a life insurance policy that will give your beneficiary tax-free money with the leverage that is there. I mean, that's how you really extrapolate wealth. I don't think a lot of people out there understand that, but I will tell you this. The very wealthy in the United States do understand that, and that's how they extrapolate their wealth.
Well, again, if you would like to look at formulating the plan, if you would like to understand how and what accounts are best to be utilized for your lifetime income purposes, and then how and what tools may provide leverage for that generational wealth or leverage for income for your own purpose in retirement, pick up the phone. Give Tim Stearns CFP a call, 800-640-2256. That's 800-640-2256, 800-640-2256. The balance of those funds, Tim, if they are not liquidated by the 10th year, there is an excess 25% of the balance tax on those funds for excess accumulation.
Exactly. So you want to make sure you're cognizant of the fact that you do have to drain it within 10 years. I marvel in our retirement classes, which again are coming up in September and October throughout Chicagoland, that the people that don't realize what happened with the Secure Act. It took away where you could stretch an IRA on your own lifetime. So now you do have to drain it within 10 years. So that adds to your income, regardless of how old you are, you're going to have to pay more.
Yeah, I think the headline grabber with the Secure Act and the thing that everybody focused on, Tim, maybe it's because that's where they wanted us to divert our eyes, was that they moved the RMD age back by a couple years, but they gave us a couple years on the front end and literally took away generational tax deferral on the back side of that. So it was not an even deal with the delay of those RMDs required minimum distributions.
Exactly. So, and that brings me another one that, that they've taxed us for since 1992. And earlier than that, a little bit of it was in the 1980s, Social Security. If you make too much in retirement with all these different things, you could be taxed up to 80% of what you're receiving in Social Security.
And too much is not very much at all, is it, Tim?
Exactly. And the thresholds are for a single person, and then for a couple are not much at all. So we need to be cognizant of that too, that only in America can you put money away your whole life to then take it out and it gets taxed again. So kind of not a fair, even deal there for anybody.
25,000 to 34,000 for single individuals, and then 32,000 up to 44,000 for married couples. 50% of your Social Security will be included as taxable income on that lower threshold, and 85% of your Social Security included as taxable income if you cross those upper thresholds. Tim, I imagine with the trouble that we're hearing about the Social Security trust fund running dry, that at some point in time, there's got to be discussions of 100% of Social Security becoming taxable.
I agree with you. I mean, and we've seen this where they've moved up the bar, then they moved it up again. So we need to be watching that and, make sure that we understand what exactly that will do to us. Again, it's the taxable income. So I would tell anyone out there that's still participating in 401ks to do Roths. I would tell people to look at life insurance as a vehicle that you can put some cash into that would grow tax deferred. And then when you pull it out of there, it's tax free. But there's a lot of ways to circumvent having to pay taxes, and nothing illegal. I'm not saying that, but it's something that, that is out there for us. It's just kind of out of the normal, and a lot of people don't know about it. So get educated on what you can utilize to mitigate taxes.
Sticking with Social Security for just another moment here, Tim. Also, some states tax those Social Security dollars and some don't. So depending on where we choose to reside in retirement, we may need to be prepared for that.
Right. And the big tax that we've seen within the last 5 years has been IRMA. That's number 3 on my stealth tax. Basically IRMA is basically, if you make too much money, your Medicare is going to cost more. And they look back 2 years. So I have a lot of people who, I'm going to retire when I'm 65 and I can get Medicare. I don't need benefits anymore. I can get it from them. Well, guess what, guys? They look back 2 years. So whatever you were making at age 63 and 64 years old, they're looking at that. And what they'll say is that the normal person who's not a saver or what have you, doesn't have a lot of income, just living on their Social Security, they pay a pittance compared to the penalties that we're paying. So if you make too much, you will be paying that amount, and it's brutal, but it's true. It's means tested, and it's here to stay.
Part B premiums begin this year at $164,
Yep.
and depending on your income, can be as high as $560.50.
Yep.
So yeah, it's a pretty significant increase or potential increase there, Tim, if we have set our affairs up in such a manner where all of the income that we generate is taxable income. And yet another one where if we do some proper prior planning and understand the impact of how taxes seem to compound with Social Security and Medicare, we may be able to arrange our affairs in such a way to avoid it.
Well, I mean, who wouldn't want to legally avoid taxes? That's why we have a CPA on staff that can mitigate taxes, kind of get a plan together that people would like, to push those taxes down and maybe avoid IRMA, maybe avoid being taxed on your Social Security. There's things you can be doing to get ahead of this. What I see with society is that normally we're behind it and we're trying to fix our tax bill after the fact. So that would be something, which brings me in. Another one is the net investment income tax, which was part of Obamacare, if you remember.
But Tim, with IRMA, this is one place where you can request an exception with the government. You can appeal this.
Yep.
If you have circumstances that would merit it, like retiring, a big change in income. It seems to be an area where they've got some understanding that people might not have the same income in retirement as they did during their working career.
So we've helped people, appeal this, and we're 50% on that. We've seen people do this. I think it kind of depends on who you get over there, but I mean it's a process that you can definitely try to get them to waive it. We had a person who sold their company. That happens once in a million years, right? We also had a person who got RIFT, reduction in force. He appealed it successfully. Because he said, I've never made that much, but they were paying me to leave. So a reduction in force caused him to have a much larger income than he was used to. And that's the type of thing that's once a lifetime. They'll give you a shot on that and they'll mitigate it and reduce it for you.
But even just a one-time kind of income event, Tim, potentially puts your numbers in a place where you might be subject to IRMA.
Right. And remember when you said it was $560, that's per person.
Per
so
month.
If you're married, per month, that's a really a kick in the pants. If you're not used to having to pay that, especially if you're coming off a work plan where, they took care of you at least and maybe did something for your spouse. So, I mean, these are things that people, when they go to retire, those are the things that we kind of needle them around. Make sure that they're thinking about those things. With an income allocation plan, we try to uncover all those rocks to see what's underneath them and ask them, did something happen? Oh yeah, I got a big severance package that, I made a lot of money this year. Well, guess what? That's congratulations, but that could hurt you with IRMA. This is what you're probably going to need to do appeal it. These are things that you can't go into this by yourself. There's so many things when you retire that I find people are so overwhelmed by the fact that they are going to be retired. They're happy but scared, right? They're a little anxious. Where's my check going to come? What does my next chapter look like? How much am I going to spend in retirement? Is it going to be more? Is it going to be less? Is it going to be the same? Am I going to live here? A lot of people in Illinois want to get out of here, unfortunately, but I get it. We've had a kind of a mess in Springfield for a long time. So these are the things that you need to think about when you're going to go retire.
And we'll talk specifically about state taxes in just a few moments. We'll get to that one because that is a big concern. But again, ladies and gentlemen, you've got to set your plan up in a certain way. And there is an optimal way. There are more advantageous ways to structure your finances for retirement. And that's what the benefit of working with a retirement planning professional like Tim Stearns, CFP, would be for you, is that you get the education and the understanding of how those can be arranged in an optimal way. Pick up the phone, give a call if you would like that protect and grow plan put together for your situation. 800-640-2256, 800-640-2256. Tim just did a quick calculator for a married couple hitting those IRMA threshold. That's an additional potential up to $9,494 extra dollars for Medicare premiums per year, for your health insurance per year. And by the way, we're just talking about Part B here because Part D also has that same means testing, correct?
That's correct. In our class, we cover all this. B and D are income tested, right? They're means tested. So if you make under a certain amount, that's great. You won't get charged as much. But if you don't, and you're having these IRMA events in your life, it's something that you definitely want to try to avoid. And if you can't, this year, maybe get ahead of it for next year so that you're not doing that. And again, right now with Roth conversions, we have taxes at their lowest. Might be a reason to do it, to do some Roth conversions, regardless of your income, you're able to do that and then see kind of where you're at before you get ahead of the IRMA situation.
Number 4, Tim, stealth tax on net investment income. What do you mean here?
Well, I mean, one of the things that they put in when they put in Obamacare is that if you make over $200,000, the state can tax you 3.8% more, which is another thing that I don't think people know that's going on. They see their tax bill, but they don't see the ingredients that go into that. 3.8% is a lot. And I see a lot of people making $200,000 in their investments in retirement because they have things going on that they, from their old lives, rental properties, et cetera, that are kicking off $200,000. Plus they have their Medicare, their Social Security coming in, and then they have their, income from just living. So this can get you into that 200,000 real quick. And, with inflation being the crazy way it was this past year, I see that being a lot more that happening a lot more with people out there, unfortunately.
Yeah. So if you are in the 24% marginal tax bracket, suddenly you're paying 27.8% tax on that interest income. Number 5, Tim, widow or widower's income tax penalty. This one sort of seems unfair to me, but what do we need to know and what are we dealing with here?
Well, when you go from being married to single, I mean, usually it means someone has passed away, unfortunately. And I'll use my parents as an example. The write-offs that you can get for an individual, they go away, for one of the people. So next thing you know, you're in a lower, you're in a higher tax bracket because you're still making that same amount of money, but you don't have the exemptions that you had. Everyone's taking the federal exemption nowadays, not really writing off, the write-offs that we used to do, they would itemizing and all that good stuff. So you're looking at that's another thing. And it's an eye opener for when a widow or widower goes to file for the first time without their spouse. Usually the taxes are higher and they don't know what happened. And we explain to them, well, this is the tax bracket you're in now because you're the head of the household and single.
Yep. You lose part of that standard deduction, and you switch brackets as it is anyway from married filing jointly to single head of household, which those numbers and those rates do adjust, and generally not in our favor across the board, not in our favor. So we do need to understand that, Tim, and that is something that we probably need to plan a little bit better for spousal income dependency and replacement after our own lives in the case of a married couple, right?
Well, a great example there where you would use life insurance. The life insurance would fill up the bucket to, fix the fact that they're not receiving the other Social Security anymore, or maybe they're getting half the pension, or maybe they're not getting the pension at all. And it's all not taxable money. The death benefit would be tax-free. Meanwhile, with those life insurance policies, my wife and I own one. There's chronic care in there, which would take care of the long-term care. There's so many different benefits to having this cash value life insurance that I think a lot of people don't understand. I would tell anyone out there, give us a call and we'll explain to you kind of what we're doing and how it can help you down the road.
Again, if you would like to put that protect and grow plan together for yourself, for your loved ones, your family, pick up the phone, give a call to TJ Stearns, Tim Stearns, CFP here each and every week on Protect and Grow, talking about the importance and the value of planning and specific strategies and opportunities. But you can apply this information to your situation and get your plan put together, ladies and gentlemen. 800-640-2256 is the number to call, 800-640-2256. Tim, you spoke about itemizing and the standard deduction. You spoke a little bit about local and state taxes, but these two really do coincide here. Stealth tax number 6 is the $10,000 limitation on those state and local taxes when itemizing.
One of the other stealth taxes, like you're talking about, Peter, is this limitation on $10,000 that you can deduct $10,000 in state taxes, which in Illinois, anyone knows, we're at 4.9% right away. That adds up really quick, and you can only write off $10,000 of that state tax. So I tell people out there all the time, make sure that you understand where your tax return's going instead of worrying about it on April 15th. But that limitation is tough on people. And it's just another stealth tax that's, it hurts us in retirement that we haven't really thought about. Everyone's thinking about income tax, and luckily in the state of Illinois, your IRAs aren't taxed, your 401ks when you pull out the money by the state. All right. But with federal, they tax every penny of that. I understand that. But you're looking at with our state taxes, you pay $10,000 without doing much to get to that level real quick.
For individuals or married couples, by the way, this is one where that joint filing married return does not give us twice the amount of deduction. $10,000 across the board. In fact, it's only $5,000 if you are married but filing an individual separate return. And this applies to state and local income taxes, general sales tax, real estate tax. Tim, that's a big one in Illinois, personal property taxes, all of those sum total. If you are itemizing, you don't get to count more than 10,000.
Right.
So Tim, looking at these 6 stealth taxes, as you call them, these are things that can surprise people, but we've all got to deal with managing that tax bill in retirement. And I think it's one of the true values that you have there at TJ Stearns is that tax analysis where you can show people and quantify what the likely tax bill on their retirement accounts is projected to be.
Well, it's really a great report. It's like you said, it's an eye opener with most people. We show them and they go, "Oh my gosh, I didn't realize I'd have to pay. I'd have to pay for my RMDs. Plus, I might invest it back into something, and there's a tax there. And then, lastly, my heirs, what they're going to be paying. So why would I get ahead of it now? Well, that report hits them right in the square in the eyes that you need to do something different. If you want to mitigate the taxes, get ahead of it. I tell people, tax preparation is you should get in front of that and get it into tax mitigation where you're actually trying to not pay as much taxes during the year so that April 15th, you're not Monday morning quarterbacking what you did the previous year. And I see people doing that all the time, and people don't take heed, and they should.
Once again, if you would like to see that report, the tax analysis and projection for your own situation, ladies and gentlemen, it can be eye-opening how much you are likely going to pay in taxes over your retirement, as well as the side-by-side. We are in a great window of opportunity to manage this right now at historically low tax rates. And you can also see what that likely cost would be to evaluate for yourself if it's worth the time to go ahead and jump on this and address it proactively. And I'll tell you what, the difference is substantial in many cases. So take a look, because it's not what you make, it's what you get to keep in retirement. And you want to keep as much of your money to support your quality of life and confidence into and throughout retirement. 800-640-2256 is the number to call. That is 800-640-2256. 800-640-2256. 800-640-2256 for that complimentary report, the tax analysis, the Protect and Grow plan. Tim, such a wonderful service that you've offered for so many proactive savers and investors across and throughout the Chicagoland area, but so many more need to take a look and get that plan put together.
As you know, education is power. Knowledge is power. And finding out exactly how to get ahead of something so that you're not doing it, or spreading the word to other people. That's what we're trying to do. I would tell anybody who wants to attend a class, via Zoom, or they can do it in person, they'll learn a lot. Our classes, we cover the whole gamut, IRMA, Social Security, Medicare, how to file your taxes in a better fashion. We do all that, and obviously we're happy to do that, pay it forward to people, and we're all throughout Chicagoland area. So that's easy to get with us.
1-800-640-2256, or you can go online, tjstearns.com, office located conveniently in Arlington Heights. The classes throughout the area, the ease and convenience of meeting through technology in a Zoom or virtual meeting as well. So no excuse to not get this conversation started, not have that Protect and Grow plan put together. Ladies and gentlemen, pick up the phone. It is the complimentary service of your certified financial planning professional, Tim Stearns, CFP, your own specific, unique, and custom crafted Protect and Grow plan for your financial and retirement future and confidence. 800-640-2256. Tim, always a pleasure. Thank you for being here.
Thanks, Peter.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.